And we're live, I think. Hopefully. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Special guest today, Ian Cassel.
In the house.
The MicroCap King. Small and MicroCap King.
What an intro. Thanks for having me on.
Good to see you, Ian.
King of the Lilliputians. Is that,
we haven't done this for a while.
Well, you know, it's interesting, Toby. I was actually going to throw you a softball, you know, right out of the gate, if you're ready for it, which I think you are, because this is right up your alley. But
people that come here for my views, but they're here for yours.
That's all right. We'll get to that. What's more interesting is I actually dove into what you've been saying for the last 10 years and wanted to talk about it now finally. But
you finally look cheap enough.
Ian, can I squeeze in one quick thing before we dive into softballs for Toby?
Yes.
So I have a request of the 10, which I don't often make, and that is that we have so many tons of awesome ideas to build at Journalytic right now that I need help. I need more help, and we need at least one, maybe two full-time software developers to join the team. So I'll post something on Twitter. I already did with more details about it, but we're looking for a very user-focused engineer, preferably more than 5 years of experience, ideally with both a passion for coding and investing would be great, because that really helps to have more kind of sympathy or empathy with the user. And, you know, it has experience building user-facing web applications. You know, this is a startup, so of course it's tends to be more about equity than it does about salary per se, but doesn't mean we're still. And you're not going to be making, you know, day in the life of videos on Instagram from what we're doing, but it's a pretty rare opportunity. So I think please, if you're listening and you're that person, or you know someone who's an A+ developer, please get in touch following through on this website. And I know the right person's out there. We just need I need a little bit of your help finding them. So that's my request of the 10 for today. So carry on.
Is that a paid position, Jake?
Oh yeah, it's a full-time paid position.
Yeah.
It's a real career.
No, it's paid an exposure. No, I'm just kidding.
I'm the only one who's unpaid in this whole thing.
Welcome to being a founder, right?
Yeah, no kidding.
No, I mean, just another soft pitch to you, Jake. I mean, I use Journalytic every day now, and oddly enough, it's just as much just for note taking and journaling as it is even the stock part of it. You know, I just find it really easy, really intuitive to use, and I've done, you know, a couple of Zooms with you and your team that you have, and I think it's incredible what you produced in such a short period of time, and I think you're going to make a big difference, you know, for the investment community.
Thanks, Ian. I appreciate that. Yep, we're just getting started, so got lots of even bigger ideas to build onto that. So it's very exciting.
How big is the team? How big's the team right now?
Yeah, we have 4 developers, a full-time designer, and then like a COO basically, and me.
Awesome.
Yeah.
Well, we all want to see you succeed, and I know you will. So thanks.
I wouldn't mind seeing me succeed also on this one.
let me give it, before we get into the softballs. Let me give a
geography lesson.
Tesla to the Moonville. What's up? Western Highland Park, Camas, WA. Is that Washington? Riyadh, Scotland, Astoria, Oregon, Minneapolis, Bendigo. What's up? I salute the Bendigo. What time is it there? It's like 3 a.m., 4 a.m. Madison, Wisconsin, Spirit Lake, Tallahassee, San Diego, Copenhagen, Altamonte Springs, Hamburg, Germany, Birmingham, Alabama, not England, Toronto, Santa Monica, I think. Yeah, here for Cassel's views. Me too. Victoria, British Columbia, Canberra, good one. Edmonton, Canada, Hartola, Central Finland. All right, that's it. That's an amazing spread. Good to see everybody. Thanks for joining us. Here for the great Ian Cassel. One softball, and then we'll dig into Ian.
We got all 28 of them, so it's good.
Wait, who's running the bot farm if you're on the show right now?
No, I guess the softball I was going to give you, Toby, was you mentioned in a tweet, I think it was back in May 30th, you talked about the EV to EBIT like value spread, and I think it got up to 4.3 at that point in time. That was a couple of weeks ago, and I think value's made a little bit of a rebound in the last couple of weeks, but you know, maybe not. Slight dead cat bounce, no. Well, one of the things that was interesting to me is like just historically that chart, it's up to 4.3, which I think, during the .com time period and during the GFC, it got up to 3, but historically it's been around 2. And how should somebody generally look at that? Is that basically saying that the cheapest stocks, trade at half the multiple of everything else on average? Is that the right way to think of that?
Yeah. So currently it's at 4.3. That's an Alpha Architect chart from their website. I think you have to log in to see it, but I don't think you have to. You just have to register. It doesn't cost anything. I post it every time it updates. It just shows the spread between the median stock. So I think they track 1,500.
Yeah.
Yeah. So it's that largest 1,500. So it doesn't kind of neatly fit into Russell 1000 or Russell 3000, but it's that midpoint. And then it looks at the median stock in there. So that's the 750th stock, and it compares it to the median stock in the cheapest portfolio, which is the 75th stock. So,
okay.
To what extent that adds some, makes it sort of unclear. Like, I don't know whether an average of those portfolios would be better, but I think it's a reasonable way to do it, I think. And so what it shows at the moment is that the spread between the median stock in the cheapest portfolio and the median stock of the whole universe is basically as wide as it has ever been. And it's wider now than it was in 2000 at the very peak. And what followed on from there was very good performance as that spread closed, and also wider than 2009 at the bottom, which also delivered very good returns to EBIT to that portfolio. Obviously, it can keep on blowing out. It got very, very, I would have said when you got to the 2000 peak, that was about as good as it's ever going to get, or the 2009 bottom, but clearly we've moved way beyond there. And I don't know why. It could be composition of the portfolios. Maybe it's energy heavy. Energy's over earning, and people don't think that energy can continue to over earn, or it's something like that. But I still think that it represents a pretty good opportunity set, even if energy's over earning.
Toby, do you have any sense of what the upper portion of the distribution looks like today? Because we knew in '99 that was very, very expensive, right? And you had some just really egregious. I wonder, it'd be interesting to see if they added to that chart, like what the
expensive side.
Yeah, what's 1,500 minus 75, whatever that number is, 1,425.
Well, I think
the distribution, and then overlay that on, like, where does that live?
From the growthiest stuff. The growthiest stuff topped out probably when ARK topped out February 2021.
Yeah,
and it's been coming in, and it's come in quite a lot since then, and it probably bottomed in February, and it's expanded since then. If you look at the bear market rallies in 2000, there were several that were 40% plus rallies. So
I think 17 total, if I remember right, within that.
The categorization of a market as a bear market or a bull market, I always just find hilarious. Like I tweeted this the other day where I said, we're down 10% from the peak in the end of 2021, and we're declaring it a new bull market because we're up 20% from the bottom, more than 20% from the bottom a few months ago. It doesn't make any sense to me, but if it has to be categorized, I guess that's the definition, up 20% from whatever bottom.
From anything.
I find it weird, but I don't think it's very helpful to say it's a bull market or a bear market. It's just, it's what it is. It's going up or down, and it's going up at the moment. Could easily start going down. I think there's a lot of reasons why it will, but you can fade me because I'm always pretty bearish.
Well, it was wild. Mark Vonderwell, hat tip to him. He's a MicroCap Club member, and he posted on it maybe a week or two ago. But he mentioned, really, I think a lot of people are aware of the outperformance of small cap value since 1927. So it's almost 100 years. And, it's kind of common knowledge that value stocks have outperformed growth stocks, and then small stocks have outperformed big stocks. So small cap value have outperformed overall. And what's kind of crazy is just those long duration underperformance periods. He mentioned how there was like just over the last 98 years, there's been a 17, a 19, a 7, and a 17-year period, and now we're in a 16-year period of underperformance. And so what's crazy is you've had 3/4 of the time that small cap value has, I guess, underperformed, or at least fairly performed, and yet small cap value over that duration has beat the S&P 500 by 14x. which just shows how volatile and explosive those up years are. It's important, and they're usually 5 to 7 year stretches. So
and it happened
crazy.
recently. You could see in 2020 from the bottom when it finally bounced. It took a little bit longer, but when it bounced, it was a monster bounce. It's given it all back now for whatever reason. I think that what tends to happen is value outperforms out of the bottom of the bear. Because I think that it's all of the most sensitive, they're small, so they're not as well resourced as bigger companies, and they're just sensitive to the business cycle because there's one business often in them rather than several business lines, several products. They're just very sensitive. And so there's the fear that they're going out of business, the genuine fear that they're not going to make it. Like you can see that narrative now. People are worried about, well, what if we go into a recession or a depression? Like what happens to small cap value? Like it's going to get beaten up because these are all cyclical businesses. And that's true. And then when they don't get beaten up, they recover because it looks like they're going to make it, so they're cheap.
Yeah.
So I think that's what happens. I think
the binary of when you go from zero of existential, like this could die, to like, well, it's going to survive,
and now it's cheap.
There's a lot of alpha in, I think, going from 0 to 1 there.
I think that's all value, but I think that particularly pronounced in small cap value.
How much of it do you think is just the growth of kind of index investing and ETFs, kind of leaving out the less liquid kind of companies in general? Hence, these names are just kind of falling to the wayside.
Orphaned.
Yeah,
it's always been the case though. Even before all of the indexing, like those periods of underperformance have always existed. It's sensitivity to the business cycle, which, I mean, I know that there's a theory that indexing means that all of the money flows to the biggest companies, but that's always been the case. That's not anything new. That's why the opportunity exists. That's why you get the returns if you can stomach the drawdowns and you can hold on. It's not a particularly exciting. There's really only two states in small cap value. It's terrifying because it's terrifying and we're underperforming by so much. And then there's a boom, bubble, bust. And it's over as quickly as that. It's like a firefly. But the returns in those short periods of time are so big that it's outperformed to an extraordinary amount over the whole period. But if you dig down into the composition of those portfolios, they're hard to buy. That's why I think it tends to be better as a quant strategy, or you need to be a sort of I'm forgetting his name now. Who was the redheaded stepchild to Buffett's golden head boy at Graham Newman?
Schloss.
You got to be like a Schloss type personality where you can just go in and buy the boring stuff and hold 100 positions and not worry about it. Like, even though he wasn't a quant, that's basically
he's pretty
quant type strategy.
Pretty systematic.
Yeah. I kind of think I'm not pure quant. I'm more like Schloss than I am like a quant. I try to buy reasonable businesses, very undervalued, at a cyclical bottom, and hope that if it comes around, that you get the good performance for value, that they capture it.
It'll be well deserved when the worm turns.
But let's talk a little bit about you're small and micro, but you're probably at the other end of the spectrum from me. I always think of you as being a little bit more growthy, even though I'm sure we overlap in some positions because I hold quite a few and I tend to buy some of the better stuff in there too.
Yeah.
But
would you call it, would you say it's more growth or more quality, or is that a false dichotomy to you?
No, I think I would like to think that's a fair assessment. I mean, I try to kind of combine the two areas of kind of growth and survival, because I think, just focusing on growth, basically just a growth investor, it's not right, because you also need to survive, and survival is kind of what maybe more of deep value or value focus on to a certain extent. So I think the combination of those two equals quality, growth and survival, both those sets of characteristics. And so generally looking for, companies that can sustain a high organic growth rate, one of one unique businesses, but also have a balance sheet that can endure, that have a business that can hopefully grow through a recession. Kind of all those kind of survival kind of attributes combined with the growth is what I think makes for a really unique small business. And it doesn't mean that they're less volatile than any other business or any other stock that's small. But so to answer your question, Toby, yeah, I mean, we're underperforming this year.
Spire, what are you underperforming when you say you're underperforming?
Basically the IWC, which is the iShares MicroCap index. It's kind of what I have out there. Yeah. So we're underperforming that year to date, but I mean, I even hate looking at benchmarks because we zig when the market sags, not only because of our portfolio construction, but because we have a couple very bulky positions that can either make us look like heroes in bad times or look like losers in great times, depending on the quarter or the month, So to give you guys an example, I think last year in June, we were down like 45 year to date. And then by the end of the year, we finished down 15. And so we slugged our way back,
Don't call it a comeback.
Yeah, exactly. So it's like, you just kind of live with the volatility, and the larger your largest position becomes, the more your portfolio will follow that large position. We have a big bulky position. So if you have a 30 or 40% position up or down 10%, I mean, that's a plus or minus 3 or 4% on the portfolio. That's like a 3 or 4% position going to zero or doubling. That,
and they're small, so they tend to move around like that too. They can just trade
they do
wide. Yeah, it's meaningless, noisy.
It's interesting right now, the time period we're in, because we're having some the Russell indexation is occurring. We're kind of right in the middle of that, where they announce who the new additions and deletions are and so that can influence some things, but it's usually not as much or pronounced as what you think. It's sort of like this voodoo black world of how do they actually acquire these shares. There's some companies that I follow, like I know one of them I own, or two of them I own, that were included. And then there's a basket of other ones that I just follow. And these are situations where the indexes literally probably have to buy 25% of that company's float in a 2-month period. And all of those stocks, since they announced the addition, are down, since they, really? It makes and so you're like, and there's all this, hearsay on the MicroCap Club or other boards too. Like, where do they get these shares? They're, it's the algos accumulating or shorting this to that. And, how do they block off this stock and all, it's all basically a big distraction, to be honest with you. But it is an interesting time period because of some of this volatility you're seeing because of the Russell inclusions.
Do you see the volume go through? Does sufficient volume go through for them to have amassed the position that they do, or you don't even see the volume go through?
You normally see it the day of inclusion, which I believe is June, was that 24th, 27th? Somebody's listening to this probably knows. It's one of those dates.
Mark your calendars.
And usually what you see is in the last hour of trading, you'll just see volume, and then some block trades go off in those securities. And that's when you're wondering, well, how did that happen? Or who's the other side of this? That
they warehouse them somewhere.
Yeah. And I mean, some people believe like there's like they start actually acquiring shares months in advance. But it still kind of doesn't make sense. So it's a fun thing to just watch and try to theorize.
Put your tinfoil hat on and then.
Exactly. Yeah. Exactly.
One of my favorite strategies used to be buying stuff that fell out of the Russell 2000. I've done that a few times, because it gets trashed the day that it comes out. And then if they're reasonable businesses, like there's a good chance that they get included again in the 12 months time, if they're reasonable businesses, you don't mind holding them, then they do get included and they get that pop, and you can jump back, you can sell into that at the same time. But that's not accumulating in front of them, that's just accumulating when they come out.
I would wonder if go ahead, Ian.
June 23, June 26 Brown Maribosa.
Okay. Yeah. I mean, and I know there's the other indexes like Vanguard has some small cap indexes too that have inclusions that are not the same time. And those I've found you do see a reaction. Even the S&P has a couple other indexes that I know when Expel got included a year or so ago. I mean, you saw 10x average volume in a day or two and that thing up 25%. So you see it in some things the way when they're included, but not others.
Interesting.
Brown Maribosa says the ETFs make a deal with a broker to guarantee the close on entry on the 23rd. Then they split the profit between where the broker is able to buy the position and the entry price. Interesting.
Yeah.
Brad, actually, Finance has a good thing about the Dan Rasmussen's crisis investing paper nicely quantifies the factors that bounce out of the bottom: small value, illiquid, some debt, and some cash flow. That's a good portfolio.
Yeah, no, it's definitely an interesting time period. One of the other things that I've been writing on, switching subjects, is Jake, this will probably interest you too, is kind of this overall thought process of the gap between whether it's sports or whether it's art or whether it's whatever it is, the difference between being very good and great. how much of a gap that is.
Yeah.
And you see it most easily in sports. I was reading this article about Matt Ryan. He was the Falcons QB for a lot of years. And I think, where did he go, to Colts or Texans? I forget where he went.
Yeah.
Colts. Yeah. So he ended up, there was an article in ESPN that was written about him, and where, it's kind of a depressing article, but he during his career, actually, I think historically, he's in the top 2% or top 98%, however you want to call that, in overall statistics. So he's up there, but no one would consider him one of the greats. And you could say it's not winning a Super Bowl, or we're not winning enough playoff games, or blowing a lead too many, that type of thing. But it's fascinating when you look at that cross sports. I read an article on golf as another example. It was pretty interesting. They mentioned if you're a PGA Tour player, and if you just shot even par every single tournament during the year, like, where would you stack up?
Yeah.
And so if you shot even par every single round the PGA Tour, you would have 41 starts, you'd miss 22 cuts, you'd may have 16 top 50s, 6 top 30s, 1 top 20. I think you'd make 1.1 million, and you'd be 118 from the FedEx Cup. So that's even par. If you were
basically buying the S&P 500, right? I mean, that's indexing.
Yeah. And then the other one was, if you were just 1 under par, if you average 1 under par every single round, so 41 starts, you'd only have 12 missed cuts. You'd have 24 of the top 50s. You'd have 7 top 20s, 4 top 10s. You'd make 2.8 million. You'd be 26th in the FedEx Cup points. So from averaging even to averaging 1 under par every round gets you from 93rd to 26th, I believe, or something around there. Now, if you went to 2 under par, say you average 2 under par every single round the PGA Tour, 41 starts, you'd only have 2 missed cuts. You'd have 31 top 50s, you'd have 13 top 10s, 2 wins, and you'd be number 1 the FedEx points. The difference between even par and
shooting a under par 72 and shooting a 70.
Yeah, and it's pretty wild. I mean, and you see that across all sports. I mean, you could
tennis has another one like that, where, like, I think it was maybe Nadal that they had the numbers on, or maybe it was Djokovic. He started winning like 52% of his points instead of like 50.5 or something. I mean, it was just a real marginal improvement. And then, like, all of a sudden, like, sets you're winning, tournaments you're winning, like, it's like you're like 90% chance of winning at that point, the whole thing. It's insane. Like, it's these little tiny micro improvements. This is what I find it to be so fascinating in the investment context, is that there are all these little tiny accumulations of advantages that we can get if we work on them. And they're none of them are, there's no silver bullets. It's just about finding little places to improve, but they add up in huge ways, and they make it so that you end up having a really good shot at doing well.
This is actually an advertisement for Journalytic, but anyway. No, but it is interesting. That's, like, I was journaling about it, and I was kind of, same thing with baseball, as Jake, you love baseball too. It's, difference between getting a hit 25% of the time and 35% of the time is about $20 million a year in the major leagues, which is kind of crazy when you think about it. So bananas. There's all these instances of just small incremental improvements can make a big improvement, or distraction, in the game of sports, or also in investing, and one of the hardest parts with investing, as we talked about, Jake, is just that ability to know if you're tweaking, because of the time lag in the feedback loops of investing. It just takes so much time to know if what you've changed is working.
Yeah.
You don't want to wait 10 years to see if what you are changing now works or not,
But so you also don't want to overfit to the last bit of time and fight the last war.
Yeah. But I think that's where, just having better tools, and this wasn't meant to mention Journalytic, but having better tools to be able to just track your decision-making, track, your watch list, or maybe you have sort of a bizarro portfolio of things that might represent a different way of how you would invest, but something you've always wanted to try to see what actually works over time. But anyway, that's something I've been journaling about a little bit more. I might turn it into an article or something at some point.
You've been on a tear with articles, by the way, man. You're covering all kinds of ground in these story after story. Like, what I like is it's stuff there's stories I haven't heard about before. I don't know where you're mining these from, but it's good stuff.
Now, it's been fun to get the creative juices flowing a little bit on the writing side. And I get really, bored writing just about investing. You know, I like to have some sort of personal connection there or some other historical connection there. So it actually connects with people and not just reading numbers and, you know, stuff like that. So yeah, it's been fun.
One of the interesting things about sport over time is that there's an Australian batsman, Don Bradman, who's sort of like a Babe Ruth type character, like around about the Great Depression, and outstanding. Like you can substitute Babe Ruth. It's exactly the same idea. Just massive outlier. Cricket. So
is there a real sport? Or?
Well, you can use baseball. Just
joking.
So it's like Babe Ruth is an outlier from that period, and it's unlikely that we ever see anybody like Babe Ruth again. And the reason is not that Babe Ruth was so much better than everybody at the time. It's that the distribution of talent, the distribution of skill was so wide, just because they hadn't sort of made the training quite as consistent. So you had more worse players to pick off. So the average hasn't moved up much. It's just the distribution is much more tighter,
right,
than it once was. So the
paradox of skill, that Mobison's written about.
That's it.
You get tighter outcomes.
I was reading an article about, I think you guys might know something about this. Like they were talking about just the advancements in sports, about how generally people are getting faster, stronger, better, you know, blah, 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 blah. And like the only one where the sport hasn't gotten faster is horse racing, you know, and I forget where I was listening to a podcast. They were talking about this, where like the horses are, you know, like Secretariat's still like the fastest horse that ever did, you know, like nothing, there hasn't been advancements in that way. And because of, I guess, some of the diversifying of genes, like throughout the years, they still use the same bloodlines. And so they've been kind of diluted down or what have you. I forget what the reasoning was, but that was fascinating.
There's also the thing that they, if they jump out in front on a sand track, they tend to win by a long way. Whereas on grass, they tend to be a little bit tighter together. I vaguely remember that statistic. All Australians have like a base level of horse racing knowledge because there's a Melbourne Cup once a year. And so we all have, I know nothing about horse racing other than like that little tidbit. So that's probably even wrong. I forget you heard that. I've got this little chart. So I'm going to try and do this chart sharing.
Okay.
Ian prompted me to do this. So this is absolute forward P for the Russell 2000 suggests double-digit 10-year returns. And I thought it was, I was going to talk about the chart, but now I'm going to try to share the chart. So we'll see. Very quickly. You guys see that coming through?
Yeah.
Can you see my cursor?
Yeah.
Does the cursor show up? Yeah. So the forward returns are good for Russell 2000. Does that help you at all, Ian, or do you slide underneath those?
No, that's a good chart. Well, I remember, well, we were talking about, I think before we started the show, about Joel Greenblatt. He did a couple interviews recently. I think he just did one a few days ago, but the one that I believe Mark Vonderwell posted on was done back in March, where Joel Greenblatt talked about how cheap the cheapest decile is. In fact, I think he said that they were, at that point in time, they were in the,
I have that up. Keep talking. I'm going to share it.
Yeah. 90th percentile of cheapness or something like that. And where historically, whenever the cheapest stocks got down to the 90th percentile of cheapness, the forward returns were 50 or 60%, something like that. Oh, right there it is.
Yeah. So it was when we started talking about this, when it got over the 90th percentile. And so the forward, Gotham yield 13.67, forward returns were 62%. And then you just move up. It moves up pretty quickly here.
Yeah, it's unreal, actually. I mean, it's a pretty good dispersion around, like it's not the worst data spread you've ever seen, right? As far as sort of showing a relationship that makes sense.
It should make sense. How do you feel about your portfolio? That's a no one's ever going to give you a bad answer there.
I hate the setup, but I love my portfolio.
Do you have statistics? Do you have anything like that? Like, do you see? I mean, do you think like that's what the way I think about my portfolio is that basically what you've just seen, that yield on the portfolio, plus I can see a reinvestment rate and the return on that reinvestment rate. And so those two combined together gives me this like expected return, which is how I think about the portfolio. So when it goes against me, the expected return goes up, so I don't feel bad.
Let me try to reframe it for you, Ian. In all the years that you've been doing this, how do you feel about the prospects of today's portfolio for you versus other times in history?
And what metrics are you looking at? What are you thinking about when we're making that assessment?
At least for the basket of stocks that I follow and even the watch list, in general, I don't know if they've ever been cheaper, and that's cheap is in the eye of the beholder. But, and you can pull up the IWC. I mean, it's up like 4% year to date. It's not like microcaps have been crushing it overall, as a market cap class. But kind of in generally how I think about it is, when I'm looking at a business that's, again, unique, hopefully a one-of-one business that's publicly traded, hopefully growing 20% plus organically, hopefully has a balance sheet that can endure. Hopefully it's profitable. If not, it has a clear runway to profitability. As long as I'm buying that company at a fair value or less, I initially make that purchase. I oftentimes believe that, and I think it plays out over the last 20 years of me investing this way, but my forward returns will match the organic growth rate of that business. Because I'm basically
revenue growth rate.
Yeah. And historically that's been pretty, as long as you're not paying 20 times sales for something, let's say you're buying 4 times sales, and let's say that's below, the industry type of multiple for that subset of companies. As long as you're buying at or below that point, and as long as the company's not going to dilute you, your forward return should likely match that organic growth rate of that company. And that basically means no multiple expansion. Right. God forbid you get multiple expansion over top of that, which we all know like levers that return up a little bit more.
That also would mean that you're not really banking on margin expansion either.
Not
where's the operational efficiency that might drive further bottom line?
Correct. Yeah.
Kind of interesting.
So that's kind of the overall general theme of how I think about things. And so from that perspective, always looking usually 3 years, but let's say 5 years out, where do I think this business will be, on the revenue side, even profitability side, operating margin side? Do I think it can continue to grow, let's say 30% a year the next 3 years? If I don't think they're going to dilute me, they have a clear runway to get there. That's generally what I think their overall return should be for that equity. And I'm actually writing about this. It's probably a blog post this week. I'm titling it "Lightning in a Bottle." Some of the best performing microcaps kind of have, I would say, 3 kind of core elements. Number one, they were small, and so small could be sub 100 million. Let's just call it that. And generally it's that way because you have the full pathway of discovery yet to occur in that equity. If you're sub 100 million, you're usually you're going to get some maybe institutional ownership, but you're mainly retail owned. So you have yet to experience the institutional discovery of that equity, which pushes it up as the volume increases, bigger pools of capital find it. The next kind of thing is either a high organic growth rate or a high operating leverage business. Either one or two or both of those things combined are crucial. And number 3, a small outstanding share count. And when you combine all those 3, you have what I call kind of lightning in a bottle. And I kind of came up with that lightning in a bottle phrase from, it's actually, I forget who it was. It was this guy, Peter Muschenbroek. I don't know, he's from the Netherlands. He's the one that developed the Leyden jar. And that's the jar that actually Benjamin Franklin used to capture the lightning in 19 or 17.
Literally lightning in a bottle.
Yeah. Like a lightning in a bottle. Like he was able, and basically that was the predecessor to the current capacitor, was this Leyden jar. And so that's where I kind of started down this pathway of lightning in a bottle. And that's kind of what these stocks are. And what I found, the companies that make the biggest sustained moves upwards, because you find microcaps that can go from 1 to 5 or 1 to 10 and go back to 1. I mean, you can find them and you can do well, trying to play those. But the ones that actually sustain the momentum are ones that produce earnings per share really, really quickly. They go from 0 to $1 to $2 in earnings per share really quick. And it takes everybody off guard. And because there's a scarcity of shares, there's illiquidity. Again, one of those 3 things was a small outstanding share count.
Would the implication for that at a portfolio then be like, if it's not working within a year or 6 months, turn it over and you got to get to the next one. And then the ones that do work, you hold them, but you kind of you have a more active farm system, basically, one way to think about it.
Yeah. I mean, and I think And so I posted some ideas on this to MicroCap Club on our forum. And, we had some discussion going back mainly on, I think everybody would agree on the start small, high organic growth rate or operating leverage. What I mean with operating leverage is you can obviously find companies that can grow revenues 5%, but they have such high fixed costs, where every incremental dollar basically falls to the bottom line. So you can have things growing 5% that can grow the bottom line 100%, and there's also going to be lightning in a bottle situations because that really impacts the EPS line. But where we were going back and forth was just on the small outstanding share count. And I do find when a company has, 10 million shares outstanding or less, I think it just sets itself up to be a Picasso type situation, like Pablo Picasso.
Scarcity,
yeah, scarcity. And, Pablo Picasso, I think he produced 1,900 original paintings over his career. Most of them are being held by private, collectors and museums. Very few of them come up for sale every year, maybe one or two. And when there's one or two come up for sale, they go for tens of millions or $100 million plus because, it's a wealth or status symbol owning one of those paintings, and there's just a scarcity of those types of things out there. And I think when you find a great business that is a one-of-one business and it's a, high organic growth rate, it has a few amount of shares outstanding, there's always going to be another wave of capital that wants to participate in that. And when you have a small amount of shares outstanding, people have to pay up, to acquire shares, just like that Picasso. And that's what I'm interested in finding. I mean, it sounds too growthy to say this, but I believe it. Like I'm going to find things that are undervalued that can get overvalued.
How do you, what do you do about figuring out management to make sure that small number of shares doesn't become a large number of shares that are in their pocket?
Well, I mean, I think what I found, I remember I did this was like 6-7 years ago, but overall, I believe it's around 16 to 17% of all microcaps, at least in North America, are profitable.
Okay.
And, usually when I tell anybody that's new to microcap investing, focus on those 17%, and a lot of your worries go away.
Right.
And I remember this was a long time ago, but I remember looking at what was the share structure of the companies that were profitable. And what I found was I think at that time, it was like 45% of the profitable microcaps had 20 million shares or less outstanding. And so it goes back to that whole theory of, great owner operators, people that care about their share structure and that treat their shares like gold, it makes sense that they would have less shares outstanding. They don't dilute readily. They don't want to dilute, they want to keep those shares. They know the earnings power of increasing EPS. And so generally what I find too is like the companies that have a small amount of shares outstanding that don't have preferred or different classes of shares, don't have a lot of warrants or options, that incentivize properly. I mean, there's people that are doing the right thing, are mainly these companies that have kind of a smaller amount of shares outstanding. Because also, especially here in the US, not to cut you off, Toby, but not here in the US, the other thing about few shares outstanding is, let's say you have 10 million shares out, you have a company earns $10 million a year, that's $1 per share. You have a company with 100 million shares out, they own $10 million a year, that's 10 cents a share. Well, that one with 10 million shares outstanding is probably going to trade at $10 plus. The one with 100 million shares outstanding is going to trade at $1 or $2. And here in the US, at least, I mean, you have different types. Institutions can't buy that thing that's $1 or $2, but they can look at the thing that's $10 plus because of penny stock rules.
Right. There's some structural cutoffs that kind of like
exactly
screen you out of the game there.
So when you have lesser shares outstanding, you actually have a higher stock price. It sets you up to be viewed by larger pools of capital that can potentially participate in owning your company.
It's a pretty solid quant screen you've produced there.
Yeah.
Ian, that behavior, so March Swade answered the same thing about the shares outstanding on this podcast when he was on a while ago. And I thought about it at the time, and the reason that what I wondered was there are probably two types of management teams that come out. There's a lot particularly in small and micro-cap land where the business is sort of a marginal business, but they're using it as they're making their money by selling shares in this business. And so they have huge numbers of shares outstanding. They don't really ever need to make money at a company level because that's not how they make their money. And so I was wondering how you screen those guys out. So that's interesting. Like you basically, the function is that if the market cap is going to be sub 100 million, and you need the share price to be over $10 when it crosses 100 million or thereabouts, then they need to be 10 million shares outstanding. So it's just you back into the 10 million share number. So that works really well. That's a good little model.
And you've had a lot of companies also do reverse splits to get to that point to either stay listed, on the NASDAQ and other things. But I think,
how do you feel about those?
I think it's a good idea.
Are they hiding it? Is that like doing
cheating?
The buyback where you're buying all of the options? You issue 15% of your share capital in options, and then you do a buyback and mop it all off. Is it the same idea?
No, I mean, I think it depends on the situation, just like everything. I think it makes a lot of sense for a company that, I mean, listen, here in the US, it's different than Canada, it's different than Australia in those public markets. Here in the US, you do have less companies going public that are small and micro. I mean, yeah, you still have some life sciences companies raising 10 million going public to raise money for a phase 1 trial, but you're having less real companies go public small here in the US. And so oftentimes what you see when it comes to new ideas, if you want to call them new, is it's actually an old business with an old management team where there's a transformation where a new management team takes it over, does a capital injection, and all of a sudden that company transforms from something to something else. And so a lot of the new ideas are sort of these transformations. And I don't do a lot of screening, but me and Michael Liu, the thing we do is like large insider buys, rights offerings, things that can, put their hand up and say something might be transforming here. You're seeing like a new management team put skin in the game. That spikes my interest. And so a lot of times when something like that occurs, they're sort of already grandfathered into the previous cap table of that public equity, and so sometimes they'll do a reverse
cleanup
to kind of do. Some cleanup to do. And so a lot of times you have that too, which I don't blame them either. You want to be at the best situation to win.
You guys want to squeeze some veggies in?
Yeah, let's do some veggies. Good idea.
So this week is all about the life of trees. And so we're staying in a biology area. And a lot of it's from this book called The Hidden Life of Trees by Peter Wohlleben, I believe his last name is. And so trees are actually very interesting to study because they exist on such long timelines. And if you guys remember I don't remember which Lord of the Rings movie it was, but where the trees are like talking, and they can move around, but they're incredibly slow. I think they were actually pretty spot on with that. As you might notice, as I'm going to give you some more facts about this stuff. Most people have heard of that bristlecone pine tree, the Methuselah tree in California, that's like 5,000-ish years old. But apparently there's a spruce tree in Norway that's more than 9,500 years old, which kind of boggles the mind. But it's like 115 times the average human lifespan. But a typical like beech tree or oak tree will usually live between 400 and 500 years. And something I learned, like trees are way more social than I ever thought. They can distinguish between their own roots and other roots of other species, and they can even recognize the roots from related individuals of their own species. They can actually share food within their root structure with their related individuals. Food just meaning like sugar and water, basically. But they won't share with other species. Beech trees they'll actually synchronize their photosynthesis because some trees have a better vantage point, like their canopy is getting more sun than others, just the way that they grew and however they structured themselves. And they'll equalize out the differences underground by sharing resources underground through their roots. And it's almost like a form of like social security in a way. Like some are earning more and others earn less, and they kind of equalize it a little bit down at the root level. So acacia trees that are being eaten by a giraffe will give off this warning gas that's detected by neighboring trees, and then they'll start to ramp up. There's a crisis at hand, and they'll start ramping up like the pumping of these toxic substances to deter the herbivores that are probably going to move down the line to them. If you add a pinch of crushed spruce or pine needles to a drop of water that's containing like protozoa, they'll be dead within like a second. There's actually pretty powerful chemicals. And a lot of the chemicals that we know of in the world that we use come originally from, trees and plants and everything. Most of our medicines are derivatives of plants. And, we've just kind of like figured out how to make them synthetically. So like when a caterpillar takes a bite out of a leaf, the leaf tissue actually sends out an electrical signal, just like human tissue that's injured. And the signal doesn't travel in milliseconds though, like in humans. It moves at about 1/3 of an inch per minute. So this is like electrical signals just very slowly moving through the tree. And eventually after about an hour, it like gets to the place where it needs to, that tells it to ramp up the defensive compounds, like these chemicals, to be then reach the leaf and then spoil the meal for the caterpillar, basically. But if it kind of makes you wonder, like if trees can, they can tell actually which species is invading them. Do you want to guess how they can tell which species is that's actually eating them?
The saliva.
That's right. So they can,
way.
Yeah, they can tell the saliva of what's eating them, and then they'll release a specific pheromone that will then attract and like basically like they have this whole arsenal of different chemicals that they can release, and they can pattern match to the species that's invading them, and it will attract a beneficial predator that will come and eat that caterpillar. So like they're basically like sending up the signals chemically, like, hey, this animal's here that's hurting me, like come eat him, basically. And so researchers also found that that roots crackle at a frequency apparently of like 220 hertz, which maybe seems like not that big a deal. Like, burning wood crackles, like who cares? But what's interesting is that when seedling roots were exposed to that 220 hertz crackling, they oriented their tips in that direction, which almost makes it like trees can actually hear effectively, is another, thing that you could say. The tree canopy itself, tip in a forest, will capture 97% of the sunlight, meaning that just 3% filters down to the forest floor. And, it seems like the saplings would be starved then of energy, basically, right? But it turns out that for young trees, it's better to grow slowly and to scale in a way that allows them to build at a much slower rate, and that they'll actually live much longer then. And so, it's like modern forestry will target a max age of between 80 and 120 years before on a plantation of trees before they'll cut them down. But that would still be a very, very young tree under normal conditions. Like that's an adolescent tree by the time it's when it's 80. And so when they grow slower in the natural forest, their cells are actually much, much smaller, and they'll contain almost no air, as opposed to when they grow very fast, they use air as part of the cell. And where it comes in is that anytime that basically like the air will allow fungi to, like, when fungi gets in there, that's a requisite for air. They need air basically to respire. And so when trees grow quickly, their rings get really huge and they contain a great deal of air, and that makes them susceptible. Then if some fungi gets in there, it can feast basically. Whereas when they're smaller, if they grow slower, they're much tighter rings, smaller amount of wood, and they're much harder harder to penetrate for fungi. So they're actually much more resilient. But it's weird, like a small beech tree can be 100 years old, and it's still basically like waiting in the wings under its mother, who's like 300 years old, and it's waiting for its turn, even though it's 100 years old.
Like King Charles.
It's like King Charles. Exactly right. So in places where there's a lot of sunlight, the trees will go for broke and try to grow as fast as they can to capture all that light. But they typically don't live as long then in those situations. So, and the ones who grow more carefully will live longer, as I've said a few times now. And the ones that grow very fast are much more susceptible to drought and temperature changes, wind blowing them over, invasive species. So like to pull out the analogy, and I was going to ask you, Ian, if this fits with you, but it makes me wonder if like hypergrowth companies might be comparable to the fast growing trees that are showered by a lot of VC sunlight, that they're just trying to get as big as fast as, get big as fast as they can. And that maybe you would almost like, boy, if our growth rates are too high, then maybe that's like indicative of the fact that like, okay, it's growing a lot, but it might not be a very solid growth for a very long-term outcome. What do you think about that, Ian?
I thought you were going to compare it to that, or maybe ARC or something like that, but I was ready for it. No, I mean, I think it's pretty fair. I mean, I think it's hard to find a company that can grow very, very quickly and not be just incinerating cash. I think that's the key to it all as well. There's companies that can actually grow at a decent pace and still have the right people, processes, culture in place to sustain that and support that growth over time, including the customer, so right. So I think overall, generally, you're probably right. I was thinking about another analogy while you were talking towards the end when you were asking me that. I was reading about, remember Frank Thomas, the baseball player? So, I mean, he was just a big guy.
Big hurt.
He's like 6'5" or whatever. But he was also known, he was in that steroid era with McGuire and Sosa and all those guys. But I mean, he was a first ballot Hall of Famer because everybody kind of knew that he was legit. Like he was not juicing, in fact, he would take big offense to ever be, I mean, he was hitting 40 home runs when everybody's hitting 70, and he was a huge, behemoth of a person. He's, I think, one of 4 players to have including like Mantle and Ted Williams, some trifecta of statistics or whatever it is. So he's an amazing player. And I often thought about that, where it must really suck to be winning the right way and be kind of overshadowed by people doing it the wrong way.
Right.
And that's kind of what I was thinking too when you're telling me the tree story,
Yeah.
But yeah, that's interesting.
Couple good comments here, JT, before you move on. Jake's definitely doing shrooms. The other one is the Entagona War. That was it, both from Buono B.
Thanks. So one interesting last fact. So, if you think about plants, they're all about absorbing sunlight, right? But so if you thought about the sun that hits us is white light, which is basically contains all of the colors, right? And so you would think if they were super efficient at capturing all the light, that plants would actually look black because they would absorb all the light and there'd be nothing reflected into our eyeballs for us to call that a color, right? So, and chlorophyll, as you know, is how leaves process light. But what if it was super efficient chlorophyll, then there wouldn't be any light that would be escaping from there, basically, right? So there's this weird quirk apparently called the green gap in chlorophyll. It can't use a certain part of the light spectrum, and which happens to be the green part of the light spectrum. So what we're really seeing when we look at something green is that it's just the waste material, like a rejected part that the plant can't use. And that's why they're green. And it's funny to me that we find basically like the plant's reflected trash, we find that to be, verdant and beautiful and attractive to us.
What luck.
Yeah.
Yeah.
I got a question from the crowd from Samson. Is there still a recession this year? That's probably directed to me, but Ian, do you want to have a swing at that?
No.
What do you see? What do you see in your little neck of the woods? I don't mean little neck of the woods. I mean the little companies in your neck of the woods.
Well, literally the little companies in my neck of the woods, like here locally in Lancaster, Pennsylvania, I have 3 business owners I usually go to with questions. One of them owns a fairly large residential construction company. One of them owns a fairly large fleet fueling, so delivering like diesel, delivering fuel to large businesses, seeing how volumes are over time.
Yeah, this is the tip of the spear.
And then my brother-in-law runs the family business that I was supposed to take over, which I neglected to do, which they do commercial, like they do wraps on tractor trailers, trucks, basically advertising, so they're the front edge of businesses buying new trucks, new things like that.
No wonder you recognized Expel.
Yeah. Yeah, I made that introduction a long time ago. So like between those 3 kind of data points, I get a pretty good gauge on what at least the local economy or regional economy here is. And, outside of the residential construction business, who has seen some, as you would expect, some pullback, everyone else is still churning along fairly well, at least here locally. My brother-in-law's business, I mean, they're busier than they've ever been. In the fleet fueling side, he said 2 months ago, there wasn't really any kick down in volumes, but it just felt weird, like it could have turned into something, but it's been pretty consistent since then.
Like a vibe session.
Yeah, exactly. It's more of a vibe, but so I know that's not the answer you were looking for, Toby. You were probably looking more from a MicroCap perspective, but that's kind of on the ground perspective.
It's all data. Yeah, it's all good.
Yeah.
Yeah. I don't know either. I tweeted out a series of charts. I don't want to go through all of them because it'll take a long time, but
wouldn't you think it would take a fair amount of time if banks pull in their loan books and become more conservative? It would just take time to propagate, right? And you wouldn't see it right away. So I don't know. I think these are really hard, but that's something I would think.
Yeah.
The main thing that I look at, just because it's a simple metric, is that 10-3 inversion. And the 10-3 is is still very, very inverted. It's less inverted than it was, but as we all know, it's the uninversion that is the thing that tends to be the most proximate event to the actual declaration of the recession. The inversion was October 25 last year. The shortest period of time has been 6 months. That gets you to April 25, and the average is 12 months, which is October 25 this year. So I think that if it happens between now and January 25, 2024, as the sort of 95% confidence interval for when it occurs. And so I've been looking at a lot of charts. It seems to me like there's a lot of weakness out there. So I think it's probably coming up. What that means for the stock market is entirely something else, and I don't know the answer to that either. But I don't think that any of the behavior that we've seen so far in the stock market rules out the recession or rules out a stock market crash at some point, a proper one. So I'm still bearish, but then I always am. So take everything I say with a grain of salt.
Well, I think it depends on your investing strategy too. If you should care about sort of when to pinpoint things, for what I do, I'm a stock picker. I'm trying to find things where I don't have to worry about the macro as much, trying to find those types of businesses. It's one key survival characteristic, if you want to call it that.
Yeah.
But if I
like that. Me too. That's how I think about it too.
But if I was more of event-driven macro, I certainly would be looking more so.
I would have starved to death a long time ago.
Yeah, exactly. And that too. Yeah.
I'd be flipping burgers if that was the...
Do you look internationally, Ian?
Yes. Yeah.
Have you bought anything? Do you where do you look? English speaking countries, developed English speaking countries? Is that where you end up?
Predominantly. Yeah, that's a good way to characterize it. Yeah. So US, Canada, Australia, Europe, that's sort of the sandbox. We have 22. Our portfolio, we're very concentrated, but we're also fairly active under the surface in some of the smaller positions, trying to find those minor league players to bring up from the farm system.
Yeah.
Give them some playing time. They don't play well.
See how they do.
Back down.
Yeah.
And so, I think like last year, to give you an idea, we own like 6-7 companies in the portfolio. We added 8, took out 8 last year, that type of thing. And
but
so
on
we're
a
constantly
percentage weighted basis, there's like core that don't move, and then you
correct.
have a lot of churn under the.
Yeah. Trying to find the next batch of veterans, basically, that can earn the right to being paid more. If you want to look at it that way, baseball term.
Yeah. Sign up to a long-term contract.
Yeah.
You find something promising, you put a small position on, dig into it properly, or watch out trades for not trades, but watch how the business improves over a period of time, and then make a decision one way or the other and move on to the next.
Yeah, that's pretty much how it goes. It might start out as a 1 or 2% position. Even as we have like an overall framework, and that obviously kind of gets rid of 98% of the universe, and then you're left at 2%, and then you kind of have a conversation or two, you dig into it, and you might put on a 1 or 2% position as you're getting to know management. You'll fly out there, meet with them, you'll see if they do what they say, you'll see if the business executes, you average up, hopefully, if it ends up working, or you take it back off if it's something that it isn't something you connect with, or that they don't deliver. So that's kind of where the turnover occurs. But yeah, we have, to answer your other question, we have one investment in Australia, and that's been pretty good legacy position since 2019, late 2019.
Are you allowed to talk about do you talk about who you are, or you don't? Not
I have.
It's for investors.
Yeah, no, it's a company called Cogstate. I mentioned it actually, I think, on Bill's podcast. So before, but that's a company that we identified mainly from that characteristic I talked about before, where it was a rights offering. The management team and board ponying up a significant amount of capital to inject into the business, caught our attention. We did a couple calls with management. We found it to be pretty unique. They executed really well, and that was a small position that turned into probably our second largest position today.
Perfect.
Because it went up.
That's the way to make it a big position.
Yeah, and that's probably the biggest way I've evolved too. It's like, I think in the past, I think it's an issue for a lot of investors, not just myself, is just averaging down into things. And I'm very cognizant of how much capital I'm devoting to a position. So you'd rather have it a 5% position that grows to 20 rather than make it a 20% position. You know, that's the way I
Yeah.
kind of view it.
Yeah.
I like to see them win. I want them to earn that right. And it's an easier way.
Some organic growth, if you will.
Yeah. Yeah. And it's an easier way to sleep at night with a position when they've earned the right too. You know, because you already have, you know, probably a few quarters or a few years of trust built in, you know, because they've gone up, they've executed. So it's an easier way to live with a larger position if they earn the right.
That's awesome. That's time. Thanks, guys.
Yeah. Thanks for having me on, guys.
Ian, always
that was
good
great.
seeing you.
Yeah, that was fun. We'll try and have you back more often. Thanks, everybody. We'll be back next time. Same bat channel, same bat time. See you then.